Imagine you've been waiting for months, even years, and finally the big announcement hits the financial headlines: interest rates are being cut. Suddenly, Wall Street reacts, stock prices swing, and every financial pundit has an opinion. But here's the real question: what does this actually mean for dividend investors? If you're someone who buys stocks not just for the price going up, but because you want that reliable stream of income hitting your account every quarter, then interest rate cuts can be both an opportunity and a risk. I'm going to break this down step by step, in a way that not only helps you understand the mechanics but also gives you strategies to benefit in the months and years ahead. So let's start at the foundation. When central banks, like the US Federal Reserve, cut interest rates, what they're essentially doing is lowering the cost of borrowing money. Imagine you own a business and you need to borrow $1 million to expand. If interest rates are 6%, you're paying $60,000 a year just to borrow that money. But if the central bank cuts rates to 3%, suddenly your annual cost of borrowing is cut in half. That means you have more money to hire workers, build new factories, or buy equipment. And when this happens across the economy, it creates more growth, more jobs, and usually more corporate profits. Now, what does this mean for dividend-paying companies? Well, when companies pay dividends, they're essentially sharing part of their profits with shareholders. If borrowing is cheaper and growth is easier, then many of these companies can expand faster, make more money, and potentially pay higher dividends in the future. For dividend investors, that sounds like a win. But like everything in finance, it's not that simple. Let's talk about why. When interest rates go down, suddenly bonds and savings accounts pay less. For example, if you can put your money in a savings account and earn 5% risk-free, then you might not bother investing in dividend stocks that yield 4% but come with risk. But when interest rates are cut, and your savings account drops to 2% or even 1%, suddenly those same dividend stocks paying 4% look much more attractive. This is one of the main reasons dividend stocks tend to rise in popularity during periods of interest rate cuts. Investors move their money out of bonds and cash, and into dividend stocks, pushing up their prices. Let me give you a real-world example. Back in 2020, when the Federal Reserve slashed interest rates to near zero during the pandemic, what happened? Suddenly, high-quality dividend stocks, think of companies like Procter Gamble, Johnson & Johnson, Coca-Cola, saw massive inflows of investor money. Why? Because with bonds yielding basically nothing, dividend-paying blue chips became the new safe haven for income investors. People wanted stability, they wanted income, and dividend stocks offered both. But here's where the nuance comes in. When interest rates are cut, dividend stocks do get more attractive, but not all dividend stocks benefit equally. Let's break that down with some categories. First, you have utility companies. These are the companies that provide electricity, gas, and water. Utilities are often seen as bond-like stocks because they pay steady dividends and grow slowly. But here's the catch: utilities borrow a lot of money to build infrastructure. Power plants, transmission lines, and water facilities cost billions. So when interest rates are high, utilities struggle because their debt costs skyrocket. When rates are cut, suddenly utilities breathe easier. Their interest expenses drop, profits go up, and dividends become more secure. That's why historically, utilities often rally when interest rates are cut. Next, let's talk about real estate investment trusts, or REITs. These are companies that own real estate and are required to pay out most of their income as dividends. Think of REITs as landlords on a massive scale. They own shopping malls, office buildings, apartments, and warehouses. Like utilities, REITs borrow a lot of money to finance properties. When interest rates drop, the cost of debt falls, and their profits can expand. Plus, because REITs already pay out such high dividend yields, often 4%, 5%, 6% or more, they become especially attractive when bank savings accounts and treasury bonds pay very little. For example, when rates were cut in 2020, REITs like Realty Income or Simon Property Group became magnets for investors chasing yield. But not all dividend stocks benefit from rate cuts. Let's look at banks, for instance. Banks actually make money on the difference between what they pay depositors and what they charge borrowers. When interest rates fall, that margin often shrinks. So banks may actually struggle during aggressive rate-cutting cycles. Yes, they get more loan demand, but their profitability per loan can drop. So for dividend investors, bank stocks may not always be the best choice in a rate-cutting environment. Now let's zoom out and talk about dividend yields themselves. A dividend yield is simply the annual dividend payment divided by the stock price. So if a company pays $4 a year in dividends and the stock trades at $100, that's a 4% yield. When interest rates are cut and investors rush into dividend stocks, stock prices go up, which actually causes the yield to go down. So ironically, while dividend investors may love the price appreciation, new investors coming in may find that dividend yield shrink over time. For example, say you bought a utility stock at $50 that paid a $2 dividend. That's a 4% yield. If interest rates get cut and investors pile in, maybe the stock rises to $70. Now the same $2 dividend represents only a 2.9% yield for new investors. You've gained in capital appreciation, but future buyers get a lower yield. This dynamic is important to understand because it shows that timing matters. Dividend investors who get in early during a rate-cutting cycle often benefit the most. Now let's shift to a longer-term perspective. What happens if interest rates stay low for many years? We saw this exact scenario after the 2008 financial crisis. Rates were slashed to near zero, and they stayed there for years. What happened to dividend investors? Well, income-seeking retirees, pension funds, and even conservative investors had no choice but to go into dividend stocks. This drove a decade-long bull market in high-quality dividend payers. Companies like McDonald's, PepsiCo, and Microsoft steadily raised their dividends and saw their stock prices soar. Investors who recognized that environment early and held on to strong dividend growers built massive wealth. But, of course, we also need to discuss the risks. Low interest rates can encourage excessive borrowing, which may lead to bubbles. For dividend investors, this means some companies may use cheap debt not to invest wisely, but to buy back stock or pay unsustainable dividends. That's a red flag. As an investor, you want to look for companies that have solid cash flows and a history of maintaining or growing dividends, not ones that are simply propped up by borrowing. Let's bring this home with a strategy you can use as a dividend investor in a rate-cutting cycle. First, focus on quality. Companies with strong balance sheets, consistent earnings, and a history of dividend growth are going to shine. Companies that have raised their dividends for 25 years or more. These are the businesses that can weather any storm. Second, consider sectors that directly benefit from lower rates, like utilities and REITs. But don't just blindly buy everything. Look at the debt levels, the payout ratios, and the growth potential. If a company is paying out 90% of its earnings as dividends, it may not be sustainable. To put it in plain language, interest rate cuts are like a tide going out. You want to be invested in the strong ships that can float regardless, not the leaky boats that only look good because money is cheap.